All right, today we're going to tear down the playbook for launching a modern venture capital fund. We're not talking about the old guard. We're talking about a blueprint for a nimble $50 million AI-powered fund that can really compete in today's world. So let's dive in.
So let me ask you something. Have you ever dreamed of starting your own VC fund? For most people, it's always been just that, a dream. For decades, venture capital has felt like this exclusive, private club, a walled garden with impossibly high barriers to get in. But what if those walls are finally actually starting to crumble?
Yeah, that traditional model, it was built on these opaque, old boy networks and legacy connections. It was a world where who you knew was often way more important than what you knew. But today, a few fundamental shifts are happening that are cracking that old model wide open. We are entering a completely new era for investing, and it's really being driven by three major forces that make right now, the perfect time to build a new agile venture fund. First off, the market itself has just hit a giant reset button. Remember the absolute frenzy of 2021? The sky-high valuations, the FOMO-fueled deals? Well, that's over. We've moved into a much more rational environment. Now, founders are focused on being capital efficient, not just growth at all costs. For a new investor, this is a huge advantage. You get to enter at disciplined, realistic prices without being dragged down by an overpriced portfolio from the last cycle.
Second, we're standing at the dawn of a new technological supercycle. And I'm talking about foundational shifts here. Generative AI is the obvious one, but think about robotics, new computing paradigms. These aren't just small tweaks. They're creating an entirely new, wide-open investment frontiers where a small, focused fund can get in on the ground floor long before the giants even realize what's happening.
And the third shift, honestly, this is the most powerful one. The actual tools that you need to compete have been completely democratized. This is the real game changer. It levels the entire operational playing field. So let's talk about that. Let's talk about the AI-powered investor. This is the absolute core of the modern playbook. See, AI isn't just something you invest in anymore. It's the operational advantage you use to find those investments and outmaneuver the larger incumbent funds. This image just captures the new reality perfectly. You've got a small, lean team, but they're augmented by the right AI tools. And suddenly, they can punch so far above their weight. They can effectively replicate the analytical power of a legacy fund that might have $500 million under management and a whole floor full of analysts.
And this isn't theoretical. The benefits are incredibly concrete. Just think about the traditional workflow. Financial modeling that used to take days, AI can now scaffold that in minutes. Market research that took weeks of reading reports, it can be synthesized instantly. You go from spending 80% of your time on manual data gathering to spending it on strategic thinking and building relationships. That is the force multiplier we're talking about.
This quote just nails it. The advantage no longer goes to the firm with the biggest team. It goes to the manager who is smartest about integrating technology. It's about leverage, not headcount.
And this isn't just for finding deals. It's also for running the business. The entire back office of a fund has been streamlined. Platforms like what you're seeing here, from a tool called Tactic, handle complex portfolio modeling. Others, like Carta, automate fund administration. This dramatically lowers your overhead, making it totally possible for a single person, a solo GP, to run a fund with the professionalism of a massive institution.
Okay, so we've covered the opportunity and the technology. Now, let's get into the blueprint, the practical nuts and bolts of building a $50 million fund. What do the legal and economic structures actually look like?
Every venture fund is built on two key roles. First, you've got the general partner, or GP. That's the active manager who finds the deals and makes the investment decisions. Then you have the limited partners, or LPs. They're the passive investors who provide the capital for the fund. This division is critical. It protects everyone involved and sets crystal clear responsibilities.
Now, the gold standard for setting this up is a two-part structure, and it's almost always based in Delaware. The fund itself is a limited partnership. Then a separate LLC is created to act as the general partner. The reason everyone uses Delaware is simple. Its corporate laws are incredibly stable and predictable. It's the trusted, standard choice that global investors know and expect. So how does the manager get paid? Through the classic 2 and 20 model. The 2 refers to a 2% annual management fee. This covers the fund's operating costs, things like salaries, software, travel. But the 20, that's the real prize. It's a 20% share of the fund's profits, known as carried interest. This is what aligns the manager's incentives directly with their investors' success. You only win big if they win big.
So here's how that profit split, that carry, actually works. First, the investors get all of their initial capital back. The fund has to be profitable before anything else happens. Only after that milestone is reached are the profits distributed. 80% goes to the limited partners, and that final 20% goes to the general partner. It's their reward for generating a real return.
Now, here's a critical piece of portfolio strategy. A $50 million fund doesn't mean you write $50 million in first checks. The standard playbook is to reserve about half the fund, so $25 million, for follow-on investments. This gives you the dry powder to double down on your breakout winners as they grow, which, frankly, is often where the truly outsized returns are made.
We've covered structure and strategy, but there's one final element, a powerful U.S. tax incentive that a lot of people just don't know about. And for early-stage investors, it can be an absolute game changer for your net returns. It's called the Qualified Small Business Stock Exemption, or QSBS, and the headline is just astonishing. If your investment qualifies, you can potentially exclude 100% of your federal capital gains tax on the sale. Not defer it, exclude it. Now, as you can see, there are specific rules about the company type, its size, how long you hold the stock, but the bottom line is that this provision can turn a great return into a truly life-changing one. So when you put all these pieces together, the market timing, the AI-powered tools, the streamlined structure, you get an entirely new breed of venture firm. Just like the car you see here, it's lean, it's fast, and it's tech-driven. It's a model built specifically for this new era of investing. The old barriers to entry are falling. The tools are accessible to everyone. A new wave of technology is just beginning. And that leaves us with one final, exciting question. With this new playbook in hand, what will the next generation of investors build?